Okay, it is time for us to learn some basic accounting. And so what we're going to do is we're going to learn about T accounts today. And we're going to learn about how to track an account's balances and transactions through T accounts. And then we're going to pull it together by making a trial balance of all the different ending balances of the T accounts that we've worked with. And then we're going to use that trial balance to make some very unsophisticated but correct financial statements. And so that's what our objective is. So let's just delve in and see what we can do with it. Okay, so the first thing, a T account is just a way to present what transactions happen that related to a certain asset or liability or revenue account, expense account, or equity account of capital nature. And so what we've got is the T account itself is just what it sounds like. It's a T. If you look at these notes I have up front, the T account is just it looks like the letter T, and it has a left side and a right side and a divider in the middle. And so the left side of a T account is called the debit side, and the right side is called the credit side. Doesn't matter what account it is, the T account has always got a debit account. The debit transactions for that account happen on the left side, and the credit transactions for that account happen on the right side. So you just have to force that into your head and don't let it waver. Always think that the debit's going to be posted to the left. You always are going to put debits on the left. You always are going to put credits on the right. And so we start out with that. And then we think of, as you look at different types of accounts, some accounts increase with a debit and some accounts increase with a credit. And so that's a lot of what we're trying to gain in this chapter. We're just trying to learn which accounts that we're going to track their increases with a debit and which ones with a credit. So you don't need to put a negative or positive thought toward the words debit and credit, because this is called a double entry system for a reason. Every entry or every transaction that the company has is going to be recorded with a journal entry eventually. And right now we're just going to post them as entries to T accounts, but they represent the journal entry that we're going to learn how to make also. And so basically every transaction has a debit and a credit related to it. So something really wonderful for the company, like they made the biggest sale they ever made in the whole history of their company. And so they need to record this transaction. Is going to have, let's say that they made the sale that was like $250,000 for one sale. They've never made anything even like that, close to that, as far as sales in the past. So when they get ready to record that, they're so happy about it, and it's a great transaction, but still it has a debit and a credit in it. So that's why you need to think debits and credits are not where the negatives and positives are. It's just if you increase certain accounts, it's not such a good thing for the company. And if you decrease some certain accounts, it's not such a good thing for the company. So let's think of it this way. Let's say we sold something really big. Maybe we're in the, we sell motor homes or something really pricey like that. And so if we sold something for $250,000, it would be a great day for us. And so we would, if they handed us a check, then we would, even though it's a check, we wouldn't record it in an account called checks. We'd record it into an account called cash, or the bank account, or it might say First National Bank or whatever bank we use. But for accounting purposes, we call it the cash account, even if it's a checking account. And so we're going to say that we would record that in the cash account. And so we would record it in the cash account as a debit, and then we would record it in the revenue account to show that we'd made the sales, or also known as the sales account. Or if you're in a service company, it might be service fees account. But if the revenue account, whatever it's named, we would record with an increase on the credit side. So each entry, because it's a double entry system, each time something happens, we record a debit and a credit, at least one of each. And so that's why I want you not to even think it's positive and it's negative when you hear the word debit and credit. If you only were talking about the cash account, then it would mean the debits are what you want, because that's when the cash account is increasing. Whereas whenever the cash account balance goes down, that's a decrease that is recorded as a credit. Okay, so now let's back up just a little bit and let's talk about these different accounts. Well, for one thing though, wanted to mention that the word debit means can be used two different ways. It could mean I'm going to debit the account, meaning I'm going to use it as a verb, and I'm going to do an action on the T account, which means put an entry on the debit side or the left side of the account's T. Or I could say it is a debit. When you're looking at the T account and you see an entry on the left side, you'll know it's a debit to the account. Not just that it is being debited, but that is a debit in the account. Okay, so that's using it as noun, right? All right, so now let's just talk about a few different kinds of assets. Like assets could be things like land and equipment. It could be a building. It could be something called accounts receivable, which is where the customers owe us money that we provided services or goods for, and they still owe us. So that's called accounts receivable because it is receivable. We're going to receive it later. And so, or the cash balance that you have in your checking account, that cash account is an asset. So that any asset, it would be like a resource. We talked about this already some, but the assets are resources, and those we're going to record with a debit. That's their normal balance. And then on the other side of it, liabilities, which is something we owe to others, not something they owe to us, is would be things like accounts payable or notes payable. This is where accounts payable is where we would owe our vendors for some supplies that we bought that we used to resell to our customers or to make something to sell to the customers. And so those payables are things, amounts we are going to owe. And also, if you owe the bank gives you some money to start your business up maybe, and you owe the bank back. And so you have an account on your books called notes payable. And that is just keeping track of how much you still owe the bank. And so that is a liability account. And we increase those. When we increase those, we show it as a credit. So we have to, this double entry system, it was established many years ago, so it's not like negotiable. So even if it doesn't quite make sense to you, you can't say, why do you want to do it like that? Why can't we do it like this? You can't like redesign the system until you get your degree, and then you get persuasive enough to convince everyone else in the world to convert from this double entry system to something else that works better. And I'm not saying it won't happen, because it is quite likely that it could happen, but it's not happening today. So you need to just kind of like, don't worry, just take my word for it. It's double entry. We're going to have a debit and a credit every time we post a transaction. Okay. All right. So the liabilities, unearned rent is another one that we'll talk about later on, but basically that's just where somebody gives you money for something that it's going to happen in the future. It's going to be revenue to you later, like they give you advances toward the rent they're going to owe you next month or something like that. That's unearned rent, or unearned revenue of any kind is a revenue that's not time to recognize yet. So they just pay you in advance. So those are considered liabilities because we still owe them the product or service that they're prepaying us for. All right, we'll get further into that later, so you don't have to get too hung up on that. But all of the liabilities increase with a credit. And then equity accounts, if it's increasing equity, it increases, it posts as a credit when it increases. But if it decreases, if the transaction you're dealing with is decreasing equity, it's going to post as a debit. All right, so because equity has several accounts under it that are part of it, it's sort of like it's an umbrella. The way they explained it in the textbook here is that all these things together, the revenue, the expense, the capital contributions, and the drawings, these four things all contribute to the capital account or the equity, owner's equity account. And so what happens is, if they increase, like if you get a capital contribution into the business, or if you get revenues into the business, those is both two examples of increases in equity. And so those increase with a credit. But the ones that decrease equity because your equity is actually going down is the expenses that you're paying out and the drawing that you're paying out to the owners, where you pay back some of the equity back to them. So those two increase with a debit because those decrease equity. All right, so look at this graphic that I've got here. This is what I call my normal balance graphic, and it's doing the very same thing we just talked about, but it just depicts it in a way to me that makes it easier. It relates it to the accounting equation. So as you know, assets total the same number as liabilities and equity. And that's also related to this double entry system, because for every debit entry you make, you're making a credit entry also. And so if you change assets in total, then you're also changing liabilities and equity in total because of the way we record each transaction, both sides of the impact. So when assets, you got the account equation being assets equals the total of the claims against all the resources, which is the liabilities and the equity. Then that's one way to remember how these normal balances work. In order to keep the accounting equation in balance, that's why all the asset accounts are tracked with a increase showing up as a debit in their T account. And then the total equity and liabilities is increased with a credit. The only thing that makes it complicated is assets do increase with a debit. We know that. Liabilities increase with a credit. We know that. And capital increases with a credit. But these other three, whether they increase with a debit or a credit, drawing, revenue, and expense, depends on whether it increases equity or it decreases equity. So drawing is not like capital that's contributed. Drawing is taking the money back out. And so when an owner invests in the company, it's capital invested, and that it would show up as this credit to capital. But whenever the company gives money back to the owner as a draw, then that is a reduction in the equity. So that's why it's going to be posted as a debit. And then the same thing with revenue, it increases equity in the long run. At the end of the period, that revenue and expense is just going to dump right into the capital account. It's just part of equity. And so revenue increases with a credit because it's increasing the equity, whereas expenses increase with a debit because they're actually decreasing the equity. Okay, so this is really important that you get your head around this. So the textbook talks about it. They talk about it in a slightly different way, and that's great because it makes it easier for you to understand. Plus, there are thousands, literally, of videos on YouTube where they talk about this sort of thing, and you can get a lot more information from there as well about debits and credits and how they work and what the normal balances of those accounts are. So for right now, we're just taking it slow and easy. We're trying to make sure that we get our head around every piece that we're learning so nothing gets past us. Because as we go along, you need this information that we're doing today to build to get to the next step. And so you got to make sure you get this clean, clear. And then when we're ready to do the next step, the journal entries are going to be next week. Well, I think it is. I'm not sure which chapter it lands in, but probably. And so we need to have a lot of clarity about these normal balances for this time. And so the focus is on the increase side. So instead of trying to memorize which one increases and which one decreases, you get confused if you think like that. So just try to memorize if the part that you're memorizing is which side increases, the debit or the credit. Whenever I increase this asset or I increase this liability, is the increase going to be reflected as a debit or a credit? And so assets always increase with a debit. Liabilities always increase with a credit. And then the capital accounts that increase capital all increase with a credit. And the ones that decrease capital are increased with a debit. Okay, so that really is going to help you keep straight in your head. Later, we're going to have a couple of complications that we're going to have to add where we have this thing called contra assets or contra liabilities that are just an account that is the opposite of its normal, but it is called a contra, and you can tell that it's different. So for right now, it's going to be good if you just memorize these. But I have a little acronym I use, ADE, and it just means that's just the three accounts that increase with a debit, and it's assets, drawing, and expenses. So if you can remember that those increase with a debit, all the rest of the accounts increase with a credit. So if you see, oh, here's a new expense, we're adding an expense. Well, then expense is going to be a debit. Or here we are, we're buying some equipment. Okay, well, equipment increases with a debit. So, and then the other one is, oh, we're paying the owners. That's drawing. And so that is, as you pay more drawings out to the owner, that is another debit to the drawing account. All right, so we're gonna try to do a lot of exercises to practice on these, but that's basically how to explain it. And then what we're going to do is we're going to do a lot of exercises on a separate video to help you to apply it. All right, so once you know about the different accounts and the T account that's tracking the transactions, you can take all the activity that happened for that period of time and post it. If you had if you were a small operation, you might just have a T account for every account and track what happened this week or this month. But in actuality, it's much more complicated when you're a huge corporation. And so a lot of times their computers are, even their cash register is connected to the computers, and it is actually making the transactions post to the T accounts every time that you run an item over the scanner to buy it at Walmart or whatever store you're in. And so it's funny because it seems like you are not using T accounts or journal entries at that point, but you really are. It's just they're behind the scenes and they're still the same exact policies and processes happening, but they're just happening automatically from just scanning the barcode at the bottom of the item. Okay, so once you have tracked what happened to each transaction for the month in the T account or for the week, for today, whatever period of time you're trying to track, then you would just tally up each T account and see what's their ending balance now. You would add all their debits, you would add all their credits and net them out and put the balance on the side of the largest. Because, you know, if you had a lot more debits than you did credits in that account, then it's going to be a debit balance at the end of the month or the week or whatever, end of the period that you're looking at. And so normally, sorry, pardon the pun, but normal balances you can expect to be where it ends. When you have the cash account and you're tallying it up, adding all the debits, adding all the credits and netting it out, it's going to normally wind up being a debit balance because it's a normal balance is debit. The only time you'll have a credit balance in the cash account is if you made a oops and you actually were overdrawn. So a lot of expenses always have a debit. So if you add up your totals and you have a number over on the credit side of the T account for an expense account, it's going to be pretty suspicious. So I would probably think, I think there might be an error here. So just be careful. And just whenever you're tallying up balances for what happened and what transactions happened. And so what's the ending balance of an account? Just always think probably it's going to wind up being the normal balance. All right, so then once you know what the balances are for each account, you could pull a total and you could keep all those T accounts, the collection of the T accounts together is called a ledger. And you could keep those in a notebook where you show each one, or you could show it like in a columnar ledger account that's similar to a T account. It still does the same thing with the debits on the left and the credits on the right. Or you can just use those T accounts and then pull totals. But once you get that ledger all posted for what happened this month and every T account's in there, or every columnar ledger if you want to call it that instead of T accounts, same thing. But in any case, you have what happened this month. What you do then is you pull the ending balance for each account and put it in what's called a trial balance. Now, a trial balance is just a tally of what's the ending result of each of the different accounts. Here's the cash account. How much was the balance? Oh, it's a debit. Let's put it on the left side of this trial balance. So we put every account name of all the accounts in liquidity order, which means the same order that we have here. We put it in accounting equation order and liquidity order under that. So you'd start with assets. You'd list all the assets in the most liquid of all of them, being cash being the most liquid because it is already cash. And then everything else is liquid in relation to how fast could you turn it to cash. And then so cash and all its and all the other assets in order that they could be turned to cash. And then next after that would be liabilities. And that would be, first one would probably be accounts payable because it's the most current that's going to have to be paid first. And there in order of liquidity also, when will each one of them be paid? So how soon will we have to pay them? And then the equity accounts. and the which would be capital, and the drawing account, then all revenue accounts, then all expenses. So just the same order that we have here in this accounting equation, that's the order you would list them in the trial balance. And so the trial balance has those names of all those accounts, and then it has a debit column and a credit column. You would put the ending balance of each account only in one or the other of those two columns. So assets would have their balance in the debit column, unless it were a contra asset, but we don't have those yet. And then liabilities would have their balance showing up on the credit balance side because they have a normal credit balance. Equity, capital would have a credit balance. Drawing would have a debit balance. Revenues would have credit balances, and expenses would have debit balances in this trial balance. This is just a tally, initial pull from each T account. What's their ending balance? So if you add it all together, all the debits should equal the total of all the credits in your trial balance. And if it does, then you can feel pretty comfortable that you probably did it right. So then that's one of those things where accountants like to balance. So what we do is when we see that we equal our debits and our credits, we can have to congratulate ourselves and say, oh, I am a genius, right? So it's good to be self-confident and give yourself a little accolade here and there. All right, so here's a little clip from our textbook that I pulled from page 67 and 68. And basically what this is showing you the result that would be if you had done the transactions, posted them in the T accounts, and then pulled the ending balance from them into this trial balance. So you'd have all the different accounts. So you got cash and accounts receivable, you got supplies. And so you list each of those as debits because those are asset accounts and their ending balance would have been a debit. Then you have the credit balance account, accounts payable, because it's a liability. So obviously it's got a credit balance. And you're just looking at the T account to see that there is an entry on the right side, meaning it's a credit. So it's going to go on the credit side of the trial balance. And then you have your capital account, same deal, it's a credit balance. You have your drawing account, it's a debit balance. You have your revenue account, service fees, and it's a credit balance. Then you have these expenses, they're all debit balances. And so you've got them all listed. They put them in color codes for us. You don't normally in real life, you don't have color codes in your trial balance, but they're just trying to show you the different types of asset, liability, the different types of accounts, asset, liability, capital, drawing, revenue, expense. And so they're showing you different colors for each of those. So then once you have them all entered, you go to this bottom line here, and they don't notice it, they don't even say what it is, but everyone knows with that bottom, after you've listed them all, you leave one line for the tally. Have tally up what the total of the debits is and tally up what the total of the credits is. And that's the place where you congratulate yourself whenever they're the same number. You're like, yes, this is wonderful. So, okay. So the magic here is happening now. Once you've recorded your transactions and pulled a trial balance, you can already, even at this early stage of accounting, make financial statements from this trial balance. So in the trial balance, there's 3 financial statements that we're going to pull today from this trial balance, and everything you need to prepare the income statement, the owner's equity statement, and the balance sheet is right there in that trial balance. So when you start making a financial statement, you don't go fishing around to see exactly what happened again. Let me see if I can figure out what happened. No, you just look at your trial balance. Just pull the balance that's sitting there in the trial balance, because if you go back to the transactions and try to figure out, now what was all the revenue again, you're going to make a mistake, because you're supposed to record all the transactions and record and post them to your service fees account, post every expense and post it and put it, record every expense and put it to your their account it relates to. So when you pulled your tallies, you already accounted for all those individual transactions. Now all you need is these summary accounts for each account type. So now what we're going to do is we're going to pull from this trial balance and make an income statement. So the first statement that you do is the income statement, because you need numbers off it in order to do the owner's equity statement. Then you do the owner's equity statement because you need numbers off it in order to do the balance sheet. So the order makes a lot of difference. You have to do them in the correct order. They have to be income statement, then owner's equity statement, then the balance sheet last. Okay, so let's do it. We're going to income statement. We know we need revenue and expense on the income statement because it's only showing this current period's earnings. What did we make and how much did it cost us to make it? So we're going to look for down here in the revenue expense section. We ignore all these top accounts right now because we're just looking for income statement accounts. That's revenue accounts and expense accounts. So the revenue, the only one is this service fees. Then the expenses, they had 3 expenses. So we take each of those and list them here in our income statement and then tally up the total of them. So once we know the total revenue and the total expense, we just take revenue minus expense to get to net income. So this is a magic number that we always are going to be looking for, this net income number, because we need that. We're always looking for that net income to take it to the owner's equity statement. So that net income flows straight out. So far, we got statements everywhere that are flowing into one another in this, but so far we've got the trial balance that's leading us straight into our income statement. We pulled every one of these numbers for this income statement from our trial balance. We didn't have to go back to any individual transactions. We just pulled from our trial balance. So then once we finish the income statement, we can use the final number, the net income, and just take it down to our statement of owner's equity and drop it in under net income. So when I'm doing one of these, I always just, if I have it set up where I already know where net income is going to fall, I just take it straight to it and put it there as soon as I finish the income statement. Okay, so now look at the owner's equity statement. You start out presenting what is the beginning balance of the capital account. And in this case, this was the first year of operations. So they have 0 as the beginning balance. But in normal ongoing businesses, there's going to be a beginning balance. It's just this is their startup year. It's going to have a 0 at the beginning because they didn't have anything to come into the year with. So they start with 0. And then they added back capital contributions that were made this year. Now, if the problem will usually tell you this much capital was contributed this year, and you just drop that amount that was contributed into right there. And then I can't read it. Okay. All right. So the total investment then is the beginning plus the amount that was added this period. I'm sorry, for some reason, it just was not in focus. I couldn't see it. So if you have trouble reading this, you can look at it in the textbook. It's a little bit clearer. It's the only problem with the textbook is they have it split over 2 pages. So they have a trial balance on one page, and then the income statement is at the top of the next page. And so it helps if they're where you can see them at the same time. All right, so what we've got is there's how much investment we have. And then to the investment, we add net income and we subtract out drawings. So this is how you come up with what the capital is at the end of the period. Always. You say, what was the capital at the beginning? And was there any new capital contributed? Well, yeah, there was this time. And then, so what's the total capital we had for this period before adding in the income statement activity and the drawing? So then once we know the capital, that including new capital contributions, then we subtract we add or subtract the net income. We add if it's net income, we subtract if it's a net loss. And then we subtract out any distributions or drawing that's made to the owners. And that brings us to the total increase in equity or in owner's equity this period. And we just add that to the earlier equities, and that brings us to what the ending equity is. So basically, you just take the beginning equity, you add any new contributions, you add net income, and you subtract out drawings. And that gives you the correct number for owner's equity at the end. Okay, so that owner's equity at the end is what we're going to drop in the capital account. Basically, owner's equity and the capital is the same thing. And so we're going to drop that ending capital balance into our balance sheet under owner's equity. And it's usually got the owner's name and it says capital. It could just say capital account rather than having their name. Okay, so far we used that drawing number we pulled from here, and the owner's equity number, the capital number. That's how we knew there had been capital contributed, is we would see it right here. And then the next thing we're going to do is the balance sheet, and we're going to be done. The only thing we haven't done in this trial balance is we haven't transferred over our assets and liabilities. So these assets, there's 5 of them, and this liability, accounts payable, all need to be transferred to the balance sheet. It's not complicated. I'm not going to one at a time do it, because all they did is just copied it over here basically. And so when we start to do it, it will have a little more detail about how to pull it, but it's just nothing to it. You just put it in the order that it's in the trial balance. And because it's already an order of liquidity in that trial balance. So when you get to the balance sheet, you just list them. Now, this is not a classified balance sheet. That would be more complicated, but this one's just a standard, straight, simplified balance sheet. So all the assets I'll add together and I'll get a total assets number. And then I go to the liabilities and equity side, and I'm kind of nervous a little bit until I see if this side's going to equal the asset side, because I need it to really bad or I've made a mistake. All right, so I pull my liabilities from this trial balance. There's the liabilities in the yellow, and I pull them down to my balance sheet. And then I've already got my capital here because I just pulled it from the owner's equity statement. And so I add the liabilities and the equity together, and I come up with a number, and I look to see if it's the same as the assets number. And again, it balanced. I am so happy. This is perfect. So then you congratulate yourself one more time and say, this is wonderful. If you find an error instead, what you say is, oh, I got a little something I missed. Let me go back and see why it doesn't balance, because I know the assets is supposed to equal the total of the liabilities and equity. Okay. Thanks. I think that's all we're going to do for this time. We'll work a lot of problems, and this is going to start clearing up. But for now, I need you to make sure you stay positive, smile, say, hey, I can do this. Okay.